University of London, a colleague, a friend, a mentor, and a lot of many other things. He will talk to you today about something that I think is incredibly important and increasingly relevant. It's about financial cycles, FDI, and their impact on developing countries. And then I will discuss it with the prism of, through the prism of our recent work at UNCTAD, in a way that these ideas can be taken, and then we'll open up for Q&A. So over to you, Yannick, and if necessary, I.
No, it's okay.
No, you need the slides.
Yes, I have the slides.
But they also need the slides.
But why do they need the slides? You know. Excellent. Okay. Well, thank you very much for that generous introduction. Thanks also to INET and UNCTAD for having invited me to this summer school. The invitation came at a particularly fortuitous time when UNCTAD had published a couple of reports which I saw, and myself had been thinking through some of the relationships between capital flows to the developing countries, and worked out a way in which this all fits together. And it fits together by showing why it is that these financial flows are unstable. One can refer to them as financial cycles affecting the developing countries. Let me, in brief summary, I will just introduce the topic by saying why it is that financial cycles in developing countries are different. They are different to the cycles that we have in the industrialized countries in North America, Europe, and let's say Japan. Secondly, I'll say something, a few words, a certain digression about financing, investment, and production, because this, I think, is commonly misunderstood in development economic circles. Then I'll talk about the leading role of foreign direct investment. This, I think, the area where UNCTAD leads in research, I think, because I'll explain quite how it fits into this, along with the international monetary business cycle, or the international monetary cycle. And finally, just tie the whole thing up by explaining financial cycles in developing countries. Let me introduce by saying that, yes, the financial cycles in developing countries are different. In the industrialized economies, what we have, the credit cycle is endogenous to the domestic investment cycle. If there's an investment boom, this results in a more generalized economic boom. This has credit implications. Monetary circulation is accelerated. The there are changes in both in the supply of money and in interest rates, and of course this is reversed when the boom comes to an end and investment falls off. For developing countries, yes, they also suffer from investment cycles or unstable investment. But I want to suggest that those investment cycles are driven by foreign direct investment, or if they're not driven by foreign direct investment, then they're accompanied by booms and slumps, or booms and recessions in foreign direct investment. So that's one peculiarity of developing countries related to this topic. The second financial peculiarity is that developing countries are integrated with the international economy as principally as suppliers of agricultural and mineral commodities. Yes, there are cases of where some of this integration is through through manufacturing, but the principal exports of developing countries are agricultural and mineral commodities. And the corollary of this is that financial cycles are ultimately driven by the terms of trade on these agricultural mineral commodities and international monetary conditions. So this is this essentially is the basis of the financial cycles. The traditional approach to developing countries' financial cycles really it stems from usually an excessive use of simplifying assumptions, various kinds of interest rate parity, equilibria, covered interest rate parity, ISLM, the ISLM approach, using for an open economy, assuming some kind of interest rate parity, or some kind of a portfolio parity for international portfolio equilibrium. In general, I think this kind of approach to capital flows confuses saving with financing, and probably the most one of the most notable of these confusions has been the whole argument about the Chinese savings glut that has been put out by Ben Bernanke. This really confused saving with financing, which is something different. And secondly, it also confuses credit for investment with funding operations. And funding operations are key. There's been mention in sessions, in discussions over the last yesterday and today of financialization. What is really meant by financialization, what's really going on when people talk about financialization are funding operations. And to understand funding, we need to really understand a little bit about how investment is investment and production are financed, just as a sort of preliminary to the meat of my analysis. the standard kind of introductory textbooks on credit and banking used to make the distinction between circulating capital and fixed capital. Circulating capital was short-term debt, which was used to finance current production, short-term borrowing. And why was it short-term? It was short-term because when the produced goods were sold, you got the money back and you could repay the debt. Why was it called circulating? Well, of course, because you then had to borrow again for the next round of production. Investment is something different. Investment in fixed capital is the construction or the purchase of plant and equipment with a much longer life span, with a much longer period when the investment is expected to pay for itself. Usually this is businesses finance this from reserves, in other words, their past savings, or their short-term borrowing. So you borrow short-term, and then you start ordering the equipment or building your factory. Once the equipment has been installed, you issue new shares or bonds, with the proceeds being used to replenish the reserves or repay short-term borrowing. So this is the operation that's known as funding. Funding by issuing long-term bonds, it has huge advantages for businesses. It allows businesses to match their liabilities, their financial liabilities, to the expected lifetime of their assets. However, it requires capital markets that are largely unavailable in developing countries. And if you dig further into corporate structures, you find that where the capital market isn't developed, it's usually replaced by holding companies, which ration liquidity and foreign exchange among holding company subsidiaries. This is a very standard way system of corporate organization in Mexico, Africa, Turkey. The point about holding companies is that they internalize capital allocation within the holding company, and hence actually once you internalize capital allocation in this way, it means that monetary policy doesn't impact on corporate activities. What does that mean for monetary policy? Well, it means that monetary policy is actually ineffective. Or as central bankers like to put it, the monetary transmission mechanism breaks down in this situation. You can think of private equity and venture capital as being variants of this kind of these kinds of holding company structures. Hence the function of finance, according to Keynes, and this goes back to Keynes's treatise on money. It's not to direct saving to investment using the rate of interest as the price of investment. This is the kind of the loanable funds fallacy. It's the whole point of capital markets is to allow corporations to regulate their internal liquidity. Why have these bonds and shares been issued? The bonds and shares are issued in order to replace the liquidity that has been used up in the process of investment. And if you if you look at bond issuing announcements, in Financial Times or The Economist, they'll say, oh, such and such a corporation issued bonds. What did they do with the money? Well, they used the money usually to repay prior borrowing, either bank borrowing or even rolling over a bond. They certainly don't say that the bond was a very, I haven't come across a case where the bond is issued in order to pay for equipment. Actually, yes, I have. Airlines do this. They'll issue a bond when they buy an aeroplane. But even so, actually, they tend first to do it, with bank borrowing, but they then issue the bond to match the expected lifespan of the airplane. The whole point about it is that it allows corporations to regulate their internal liquidity. And if you want to know what really went wrong in 2008, it wasn't the problems in the in the housing market, the mortgage-backed securities, and so on. Those were just symptoms of something that was much more underlying, and the underlying problem was the breakdown of the funding mechanism. That's why you had subsequently the economic stagnation, because there were companies which had run down their liquidity and couldn't continue with their investment program. Investment fell off, and as any macroeconomist will tell you, once investment falls off, the economy slips into recession and into stagnation. Let me get back to the foreign direct investment and the leading role of foreign direct investment in all this for developing countries. Developing countries are integrated into the global economy largely through their commodity exports. And I'm going to talk about this aspect of developing countries, not so much the internal market, although the internal market is important, but the key financial relationship is the foreign trade sector. And this creates a particular vulnerability to what might be called the commodity price super cycle. I've put up here actually the Bloomberg Commodity Index, but you can equally well, you could put up the price of the oil price. You get approximately the same results, and you can immediately see why what's called the global financial crisis was considerably less than global. Most developing countries were unaffected by it because, as you can see, after the dip of 2008, commodity prices recovered and continued high, and the real problems started about 7-8 years later. That's when commodity prices fell off, boomed again in under COVID and fell off. We haven't got the yes, they picked up, of course, after the Russian invasion of Ukraine. What follows the commodity price super cycle is foreign direct investment. Now, if you follow the data on foreign direct investment, you will understand that it's divided into greenfield investment. This is the actual investment in extractive plant, machinery and premises, and mergers and acquisitions investment, portfolio funding operations, corresponding very roughly, but very, very roughly to the above funding operations. Mergers and acquisitions, buying buying control of a company by buying its shares and effectively taking over its debts. But because they both involve buying the productive assets, these are used to, one treats this, I should keep an eye on the time. This is put in together with greenfield investment to cover foreign direct investment. So there we are. There's FDI flows to developing countries. There's at the top is the greenfield FDI moving up and down. A boom again in 2022. A very strong pickup in 2022. That's the quite high actually around 2008. Perhaps another reason why the developing countries were not so badly affected by the 2008 crisis. And then at the bottom, the blue line, which is mergers and acquisitions, mergers and acquisition, FDI. And you can see this gap reproduced for the regions. Here we are for Africa. There an even bigger apparent boom taking off at the end of 2021. These are all, by the way, UNCTAD figures, the figures that were published last month. The mergers and acquisitions, very, very low. This is clearly because of and in fact going negative around 2019. This is clearly the effect of really very, very poorly developed capital markets, where in effect funding operations occur through buying and selling between large multinational corporations rather than directly, rather than through a capital market. Asian FDI flows, there you have rather better FDI mergers and acquisition figures, rather better capital market activity, quite high FDI, but a smaller gap between them. Please ignore I've just realized it's on the vertical axis it says millions of dollars, but the figures are given in pounds. I don't think that that's the case. I think it's dollars. Yes, the Latin America flows. This again is curious. The mergers and acquisition FDI is really, really so low, very poorly developed capital markets, despite the fact that much of Latin America is actually semi-industrialized. Again, an unstable movements in greenfield FDI. Oceania, well, this is very small scale, as you could imagine in that region. Not much scope for industrial development. This gap between them is one might refer to it as a certain financing gap. Very roughly, it reflects the need for financial development. Very roughly, it's the greenfield investment that cannot be externally financed. But actually, I would say that it exaggerates the funding gap faced by the developing countries. It exaggerates it because the FDI, the mergers and acquisition FDI, doesn't include domestic funding arrangements where there are capital markets or there are operations like holding companies that are offering merger and takeover activity and funding possibilities through that way. The greenfield investment data is principally drawn from business investment announcements, and one can refer to this as these are really investment decisions or future commitments. They don't actually reflect the actual cash flow as payments are made in the course of construction and installation up to the point of completion. If you're really interested in capital flows, then what should be important is the cash flow, not the announcement, because the announcement is reflects an intention. Quite often announcements are timed with a view to the reception of the announcement by the capital markets somewhere. And finally, the final reason why these figures don't really show the true domestic funding requirement is because the greenfield investment payments are between subsidiaries of international holding companies, where these transactions are very often made by bookkeeping transfers as opposed to bank intermediation, actually transferring money between banks or even and in particular drawing on foreign currency reserves. Okay, let me now introduce the other factor in all of this, and that's the international monetary business cycle, usually proxied by the US federal funds rate on a kind of on a narrow principle that this the federal funds rate reflects monetary conditions. And there you can see quite clearly the very high, this goes from 1970 to just recently 2023. You can see the disaster of American monetary policy in the 1970s and early 1980s, when the economy was squeezed hard with very high interest rates, and then interest rates coming down, the going up notably just before the 2008, 2007, 2008 crisis. And then as they realized that you cannot make the economy, you can't jumpstart the economy with interest rates, the very, very low interest rates up to about 2016. They rise again before COVID, as we all know, go back to zero, more quantitative easing, and then they've been rising since with the recurrence of inflation. The problem with the federal funds rate is that it really reflects US domestic monetary arrangements. It ignores the offshore, what's going on in the offshore markets, in particular the euro markets that had such a key role in the 1982 international debt crisis. Central bank open market operations, the quantitative easing since 2010. Here's the key issue: the willingness of commercial international banks to offer loans against the security of dollar assets and to innovate in such lending, accept new classes. By innovation, I mean accepting new classes of security, essentially because once commercial international banks start to offer loans against the security of dollar assets, there's the system runs out of investment grade dollar assets. There's innovation, new classes of security, and this innovation is encouraged by the flattening of the yield curve due to quantitative easing. I'm not going to go into the yield curve behind it. Underlying all of this is the currency swaps nexus. Since the 1990s, the US Federal Reserve has offered currency swaps to other central banks, the European Central Bank, the Bank of England, the Bank of Japan. The swaps network now includes the Bank of Korea, the Banco de Mexico, Banco Central de Brazil. So it's these are important emerging market central banks. The swaps are effectively offers to swap dollars for the currency issued by the counterparty central bank, backed by a resale agreement at the same exchange rate, which is in 3 months, 6 months' time, in effect giving the counterparty central bank a dollar loan, which has to be reversed afterwards. All of this gives rise to the internationalization of domestic money markets. Bank liquidity management migrates from national interbank markets to the foreign exchange swaps market, backed by central bank currency swaps. This is a major structural change that has occurred. I could speak more about this, but the important thing about it is that it means that the global money markets are increasingly integrated through these swap networks. Okay, so let me pull all this together. Essentially, let's start off with the investment cycle. Let's look at it as a global investment cycle, which determines global economic growth. The global investment cycle has, for years, it used to be driven by the investment cycles of the United States or Europe, now driven by, certainly since the turn of the century, driven by the Chinese investment cycle. And it's this that, globally spreads the aggregate demand effect across the world and creates the international commodity price super cycle. The super cycle is driven not by the investment cycle of any one country, but the average across the world. These commodity prices then determine the terms of external trade of developing countries and inflows of greenfield FDI. Why, if you look at most of the greenfield FDI, let's say in Africa, it's in raw materials, commodity exports, driven there by commodity prices. When decisions are made on FDI in Africa, the key figure is if you're going to open a lithium mine or if you're going to mine diamonds, is the diamond price likely to stay up long enough to recover the cost of the investment? This then sets off local investment and financing and funding processes. And these funding processes occur across different financing instruments and currencies, and these are affected by the international monetary cycle. So at various points, it becomes actually cheaper to fund or to finance a project in Africa using dollars because the local interest rates are so high and interest rate dollars are so low. Some of this is backed by the US money markets, but it's also backed by this international network of currency and foreign exchange swaps. At a later stage of this financing boom, the international monetary and financial instability may disturb the financing of investment in developing countries. And again, a classic example of this was after 2008, when the funding mechanism broke down, and a large number of industrial companies cut their investment programs substantially. A lot of Europe, North America went into recession and economic stagnation, and that eventually had its impact on commodity prices. So an international monetary and financial instability, this may disturb the financing of investment in developing countries. let me just finish off by mentioning some of the implications of the international financial of the financial cycle. First of all, the international monetary cycle affects the financing of investment, but I think it doesn't, but not the total amount of greenfield investment. Why? Because the international monetary cycle, the dollar, the federal funds rate and monetary conditions, these change. These are very short-term conditions. These change very quickly. If you're making a decision about whether or not to open up a new oil field off Angola, or as was suggested this morning, re-energize Tunisia with renewable energy rather than imported carbon-based energy. If you're going to do this, that's a long-term perspective. You're not going to look at short-term monetary, the short-term monetary cycle. What you will do, though, what may well happen is that the financing that you've used, you may swap around as interest rates change, as exchange rates change, but not the actual investment. So there's no necessary equilibrium between greenfield investment and merge M&A, FDI, or even a convergence or a divergence. Again, an interesting item that came out of the UNCTAD figures in Nigeria. Earlier this year, greenfield investment went one way. I think it went up. M&A investment went down. There's no particular reason why they should converge or diverge. The M&A reflects funding opportunities. If you're looking at actual fixed investment, greenfield investment, you should be looking at proper. You should be looking at other factors and not the rate of interest. If you want to stabilize a financial cycle, if you do stabilize it, then what it may well do is may simply make for a more efficient transmission of global investment and economic growth conditions into commodity price and FDI fluctuations. So it may not actually stabilize economies. And with fluctuations in foreign direct investment, this may also give rise to domestic investment and credit fluctuations. I would say in particular, and this affects developing countries, is a preference between domestic versus foreign currency financing. There's a whole set of additional problems that arise with dollarization, which we can see most obviously in the case of countries like Argentina or Zimbabwe. So I would say that there's no possibility of financial or monetary stabilization without counter-cyclical policy to stabilize the real economic factors. And by the real economic factors, I mean investment and export prices, terms of trade. But equally, I think there's no counter-cyclical policy to stabilize that real economy, to stabilize the business cycle without stable financing conditions for fiscal and monetary policy. And I think that actually that's the next challenge for the multilateral financing operations. Yes, there are sustainable development goals which need to be met, but there's also an important stabilization goal which does need to be met if development is going to be achieved. Thank you very much.
Okay, and can you hear me now?
Yeah, but we can't see your slides.
No, but the lovely ladies will do it now. Thank you. Okay, so my name is Anastasia Nesvetalova. I'm head of macroeconomic and development branch here at UNCTAD, and I'm head of the team who produces the flagship report of UNCTAD called Trade and Development Report. So in previous life, I was a professor of international political economy at City University London, where all the stuff that Jan just covered was very much daily concern. But what I want to do now is use this unique opportunity and also the venue, because it just shows how important this nexus between cutting edge academic research into financial theory and post-Keynesian economics is into practical concerns of policymaking today. So I'll try to connect some of the stuff or some of the issues that Jan covered with the research that we published recently over the past 2 years, and that is due to come out shortly in early October this year. The concept that Yannick accentuated very importantly is that financial markets are markets where corporations regulate their internal liquidity. And as John Maynard Keynes from, 1921, the treaties, a few 100 years onwards, we can say that in global corporations regulate their internal stuff, not just liquidity. They regulate pretty much everything inside their corporate organizations. And that's why the study of political economy where power is so important. And in the past 2 TDRs, we tried to look into some aspects of this power. In TDR 2022, we looked into the role of corporate arbitrage, or the structures of investment, the structures that hold investment, that control equity investment globally and in developing countries in particular. And we inquired whether the form of this FDI investment actually matters. We did discover that it does, and that just accentuates what you just said, Jan. Whereas this year, we took it into a very current issue of commodity price cycles, and in particular, the role of profiteering by large food commodity traders during times of volatility in global financial markets. Let me see. A visual from last year's TDR and a product of an academic project run by City University. It's called CorpLink. It was a long research project and the team working on it. It shows you the structure of a US corporation. Importantly, it's not a financial corporation. It's a normal corporation. It shows you the control or the ownership of equity chains internationally. It's a global picture, but as you can see, the most important bridge of corporate control lies over the Atlantic. It's not really dispersed. It's very much controlled by the if you want, North Atlantic or Anglo-Saxon financial centers. It also contrasts, and although it's not, you can raise questions about the contrast of these pictures. There is a contrast between the way economists like to think about the relationship between the world of trade and the world of finance, or the world of in terms of trade and the world of capital markets. As of last year, you can see all active regional trade agreements presented on the left, whereas all active international investment agreements are presented on the right. I won't elaborate on the contrast of this picture, but you can see that one geography is very dispersed, whereas the other power is extremely concentrated in what Jan already mentioned as an offshore financial center or as a euro-dollar market. But it's incredibly important to have connections to a very old European core of decision-making over rules that guide investment and FDI in particular. In TDR 2022, we looked at particular motivation, or at a very practical question: to what extent it matters that FDI, what does it do when FDI is distributed by multinational corporations who manage their corporate affairs and liquidity? What does it actually do there in developing countries? We didn't have a hypothesis, but what we discovered is partly confirming the current research done by others, for example, in the IMF, that use the term phantom investments. It partly continues the interest of our colleagues in the investment division who looked at corporate structures and subsidiaries. But we took it one step further because we looked at the functional representation of corporate power through accounting, through the discipline of corporate accounting. We discovered that the most lucrative value-creating activities, that means the legal infrastructure, financial insurance, accounting, compliance services, R&D, are typically placed in offshore financial centers and the competition states of Europe. The term competition states come from political economy literature, and the synonym for you would be neoliberal states. So even if hosted by a developing country, a global multinational enterprise would strategically locate the activities yielding most income elsewhere. The way we distinguished in our methodology why we look, or the instruments that we looked at, were balance sheets vis-a-vis income statements. So an income statement of a corporate subsidiary would present the actual operating activity, you hiring people, liaising with trade suppliers, renting a space, paying taxes, whereas balance sheet is a financial, it's a financial statement. It can just represent an asset that you own, an old mine, maybe a territory or a particular place of land. Randomly, I selected several pictures from the chapter. So this is a contrast between a multinational corporation of US origin and Republic of Korea in the global South. If to go with the theory that it's multinational corporations that deliver investment and value and create capital markets in the developing world, these pictures contradict that particular theory because it shows that most of the control lies again in the old European financial centers or sometimes the offshore islands. It's not a dispersed picture, it's very concentrated, and the rules of the game are made in the global north. We discovered in our global analysis, we had 100 such corporations in our sample, that a quarter of corporate subsidiaries in the global south of these multinational corporations have no apparent associated economic activity attached to the declared equity investment. They're there, but they're phantom. It's a term from English law, but they don't seem to have any real economic activity. They are financially a record of financial presence, but there is very little greenfield, or even if you want, I'm not even sure M&A would fit there, but it's a more micro study. There were dormant entities or phantom structures. Interestingly, such a pattern does occur in global north. in advanced economies, but the percentage of such equity holdings or equity structures is less than 1% for the same multinational enterprise in the advanced countries. That can create or can lead to different conclusions, but the disparity is quite stark. In terms of policy lessons, many more can probably be discussed and investigated, but it's clear that success in simply attracting FDI is not in and of itself conducive to making incoming foreign capital work for your development or for your economic growth. Corporate organization and corporate arbitrage does have macroeconomic consequences, and it matters which format this investment takes, who controls it, and whether it's transparent and understood. We also are suggesting that earnings stripping via corporate subsidiaries, and it's not just an aggregate picture, it goes at the level of corporate subsidiarity, depletes the fiscal space of any host economy, and efforts to reform that have been going on for the past few years, initiated by many organizations, have begun to address part of the problem. But we do need a more integrated, nuanced, and technical approach to even scoping the issue, and definitely coordinating it at a multinational level. Policy lesson number 3. Data transparency and data ownership is crucial. Our colleagues in statistics department will tell you that most data in the world are owned by corporations. It's not public, it's not state data. Public authorities at different levels may need to devise new ways to get around this or to make corporations accountable. It's interesting that as that TDR was being launched, the EU was the first regional body to seriously consider making it mandatory for large companies to spell out the details of their subsidiaries in corporate registers. As of December last year, however, this initiative was killed by the European Court of Justice at the initiation of Luxembourg and the Netherlands, who protested. Well, in Luxembourg, it was just one particular guy who owns a very large airplane company, but that's just the way it went. Later in July this year, the OECD helped persuade Australia to water down its own proposal to make global corporations more transparent and accountable in their tax internal affairs. So if implemented and integrated with similar efforts, and I think with UN backing and with your solid research, it could be that a more systemic multilateral effort can be formulated. But at the moment, there is, it's technically difficult, it's complex in terms of scoping the issues and understanding. And as you can see, there is very clear political resentment. But it's not where it stops. There is also a different issue with corporate subsidiarity and the way financial cycle and commodity cycle, in fact, affects it. In this forthcoming TDR, we looked into the issue of profiteering by big food traders and by the food trading sector as a whole. You might have seen already reports and various scopes of data that the ABCD, the 4 companies that control most of the global food trading system, have profited handsomely from the years of volatility. And this is partly what we show also in our research. You can see some data in this particular graph. It goes into 2022 and covers the big traders, the big 4, that are conservatively estimated to control about 70% of global food market. Moreover, we took it again to the next level. We looked at the sector as a whole. We studied 15 corporations that trade food and agricultural commodities globally. We understood that not only they have profited from volatility, but there was a very specific driver of their profits, and it was their operations with financial instruments and in financial markets. So the red line on this graph, profit before tax, can be seen as a proxy from that financial operation. Many of them have no secret that they're using, for example, derivative instruments to enhance their margins. They openly publish it in their public accounts, and they even stress that it has no particular relationship to their operating activity. It's just there to enhance the margins. Policy lesson from our investigation of the source of profiteering is that there is a conceptual loophole being exploited by big corporate groups. And that's the distinction between them being regulated as industrial corporations, i.e. commercial traders who use financial instruments for hedging and insurance, and them being de facto financial institutions that have full access to international capital markets, international financial instruments, various liquidity pools, and all sort of ways to manage their liquidity internally to their own advantage. They de facto have become, or are becoming, or have been transformed into, if you want, shadow banks. The first such mentions were in the literature in the wake of the financial crisis of 2007, 2010, but at that time there was not enough data or interest to go after them more seriously. This time we're putting it on the map and saying the phenomenon hasn't gone away, it's still very much with us, and it creates its own sort of risks, including to financial stability, price stability in the markets, and of course corporate governance and illicit financial flows. So on this last chart that I will show you now, you have the portrayal of the sector, or the investigation of the sector as a whole. There are 11 companies here, if I'm not mistaken. And it shows you, very crudely, it can show the financialization of food traders internally, but it shows the change of the transformation of the companies from being normal industrial corporation into de facto unregulated financial institutions. We have done it by looking at subsidiary holdings again, by investigating their accounts. And it's interesting that, as you can see on the graph, the arrows, the red arrows, the change from the relatively stable times in the markets from 2014 to 18, this is where the commodity super cycle was relatively stable, into today, where it's volatile and high. The red arrows apply to all big food traders that are commonly associated as ABCD controllers of the global food trading system. To find out how we have done it, you will have to read TDR 2020.